Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager. There are the opening bells. That means the cash market is up and running. That also means that it is Tuesday morning and we're here trading futures. And I've got my good friend Michael Fairborn out there in the chat. And all of you that are here with us this morning as we get started, welcome and thanks for joining us. If you're brand new, we appreciate you being here. If you've been here a number of times, thank you for coming back. And whether you're here with us in the live version or the recorded version, wild couple of days. We're going to take a look at that here really quickly as we get into this discussion. And I want to do that. I want to take a look at what's going on with volatility. A couple of people mentioning that out here in the mix, in the chat. Michael Fairborn is going to be there to help out in answering those chats. I'm going to give you some resources today, but we're going to talk about this, and let's get into a couple of quick housekeeping items. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. There is leverage involved. Make sure that you read the risk disclosure statement for futures and options prior to trading futures products. Also recognize that it takes separate trading authorization to trade futures. Now, we may talk a little bit about some things today, including virtual currency futures, and I'll bring up a specific point about those here in just a second. But it is important to understand the products that a trader might be considering trading when it comes to futures. So that is the case regardless of where you are trading or what it is that you're trying to trade. But it's also important to remember the characteristics of whatever product it is. So that includes margin. So understanding initial margin and maintenance margin is something that is important as well. Also, if we talk about, or a trader is considering trading virtual currency derivatives like Bitcoin, remember that those involve unique and significant risks. Make sure that you read the NFA advisory on virtual currencies and the CFTC customer advisory on virtual currency futures trading. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It's a great way to learn. It's a great sandbox to trade and learn. It is not a guarantee of future success out there in the real world. We're going to be using technical analysis. That's not a guarantee of what's going to happen out there in the real world as well. Now, one other thing that I want to talk about here, and I will mention this as we get into this discussion in the webcast, stop orders on futures products are a little bit different than they are in equities products. Stop orders that trigger market orders in equities will fill potentially at the next available price. But stop orders that trigger a market order on a futures product, that market order will be substituted with an exchange designated limit order within what are referred to as protection points. And those exchange designated limit orders may in fact not fill if a rapidly moving market moves beyond those protection points. So be aware of that. We're going to talk about that as we get into this discussion today, as we put together a couple of example trades using our paper money desktop software platform. So let's jump into the discussion here really quickly. I want to pop over to the Thinkorswim desktop software platform, where there's already some movement going on this morning. This is the VXM. This is the VIX futures product, and this is the micro VIX futures product. So I want to pop our grid open. For those of you that are just joining us for the first time, I've got this grid that I've built. It's called the Future Movers Grid. On the left-hand side, it shows the one-year daily chart. On the right-hand side, it shows today's movement on a 5-minute candle basis. I will share this grid with you in just a moment, but I want to put this trade together as we start to see what's going on. So I'm going to maximize this left-hand cell so that we can see that longer-term perspective. This is the VIX, basically, futures chart. But remember, this is the mini version of that, and this is now recently available as a tradable product. So our notional value in this particular product, this mini VIX futures contract, is smaller than the normal VIX contract, which is /VX. I'll show you the difference here in just a minute. But let's go through the specifications. The tick size is 0.01, which means that each one of these moves is 0.01. So that's why we're seeing 29.76777879, because that tick size is 0.01. The tick value is $1. So each one of those moves from 7.2 to 7.3 or 7.4 to 7.5, that represents $1 of value in that tick value. And each point value, meaning a move from 29 to 30, is $100 point value. So that's $100. So that means we take that $100 times the price. That gives us our notional value of the contract. In this case, $2,981. The difference here, /VX, which is the big contract, you can see the change in the notional value. Tick size is 5 cents. Right, so 0.05 is the other way to think about that. 0.05 is the tick size. Tick value, $50. Point value, $1,000 of change. So if this goes from 29 to 30, that's $1,000 change in the value of the contract. So we take that $1,000 times the price, times what's being displayed right here, and that gives us our dynamically priced notional value of the contract, or what that risk is in the contract. That's also going to determine what the initial margin is for the trade, not only notional size, but also what that initial margin is from the exchange in terms of what the risk is in the trade. So that's going to be something that we're going to pay attention to as we look at these trades. But we're going to go back /VXM because it is moving pretty quickly here. Now I'm going to bring our grid back. I'm going to restore our cells, and now we're over here on the right-hand side. And what I'm noticing is as the cash market has started to move, we've seen a downward, kind of a quick downward movement in /VX, right? So here was our cash market open. We saw that downward move, and now it starts to tick back up a little bit. So what I'm looking for is a potential bounce here down from this resistance, a failure at this level. So we're looking for this move back in a downward direction. And what I'm going to do is I'm going to kind of squish this down a little bit. So I've got a resistance level here that I can draw in where price kind of ran into a bit of a resistance. So I run up, pull back, run up, pull back. And now we're looking for a bounce down from this level of support. We're using technical analysis to put this discussion into the process, right? Now, George brings up a point, right? On volatility products, and in some products, because of those because there's a potential for a fast-moving market, OCO orders present some risk, right? And some products do not allow in practicality those OCO or one cancels other orders. So we're going to use conditional orders to put this trade together. The reason is if you get a fast-moving market and the price moves, the price of the contract moves up and then down, or down and then up, there is the possibility in a very fast-moving market that both sides of that OCO order could get hit, especially if one of those orders translates into an exchange-driven or exchange-substituted limit order. So there's the possibility that one of those orders could be working while the other order gets hit, and both sides could fill, and that could present some additional risk. So, George, thanks for bringing that point up in this particular case, right? That is one of those challenges, one of those things that we need to pay attention to in this context. So here's what I'm going to do is I'm going to take this distance right here, the distance between our support and our resistance level, and I'm going to take that and I'm going to duplicate that drawing, right? So I'm going to bring this down to the downside, and that's about where our support level is. Now, the next thing I'm going to do is, because I want to kind of create a level of risk and return on this potential trade, is I'm going to take that level and I'm going to duplicate it again, and I'm just going to duplicate that back down to the downside. Now, that's going to give me that potential measured move, right? This is my measured move down to about 29.22. So what I'm looking for is a move. Let me grab my magic marker so that I can line this out as we're looking for this trade. I'm looking for a move down from here to here and getting out of the trade if it goes above there. 2 times the potential reward to the risk that we're potentially taking in the trade. So let's put this trade together, because I end up talking through a lot of these trades and then we end up missing the short-term move. Now, we're going to talk about trend versus this type of swing trading here in just a minute, but I'm going to zoom in on this a little bit more closely so that we can see it as we put this trade together. So I'm going to enter this trade in a downward direction, which means I'm going to sell the contract, right? We're going to sell this contract. Even though we're seeing this upward movement, I'm looking for downward movement. See how it's failing at that resistance level. That's what I'm looking for in this particular case in this example. And this is simply an illustrative and educational example only. So what I'm going to do is I'm going to right click and we're going to do a sell custom, but we're going to do it with an OCO bracket to start, but I'll show you how we're going to change this order a little bit from these normal OCO bracket characteristics. We're going to make this a conditional order. So our order to get into the trade is here at that 30 mark, which is kind of about where it is at the moment. We're going to create our conditional order to get out if it goes to 30.82 and out if it goes down to 29.22. So we're going to use our little gear icon down here at the bottom right-hand corner, and you can see that on the right-hand side of these order lines. So this first order, that limit order to buy it back, that's going to be our target order down here. So we're going to say, fine, click on the little gear icon. We'll bring up our order entry rules, and we're going to get out. Now, it'll be a market order, but remember, that's going to trigger an exchange-driven limit order. When we create a market order, that's what happens when that market order is transmitted to the exchange. But we know that we're going to get out if this goes down to, we said, well, let's do this again really quickly so that we can see it, 29.22. So let's go through the process one more time. Click on the gear. We've got our order rules. We're going to make that a market order, and we're going to get out when this marks at or below, and we'll just type this in, 29.22. That's our target in this case, to the downside. And we'll click on save. Now we're going to take our get out of the trade if it's going against us order. And that's if this goes above 30 point, we'll call it 30.82 on this part. So what we're going to do is we're again make this not a stop order, we make this a market order. And this is a market order to buy. Now here's the challenge, right? Because this still has to be, in this particular case, a stop order. Otherwise, if we were to just put this in a market order, it's going to be within that threshold, but we've got to kind of create that condition that exists, right? So market order, and we're going to say market if this marks at or above. So we're going to change our trigger at or above. We said 30.82. We'll type that in, 30.82, enter, and we'll click on save. And now we've got our conditionals for both of these orders to get into this particular trade. Now we're going to say, fine, sell this if we can sell it for 30 or above, right? Now it's currently trading at 29.78. So what we've got to do is we've got to open up that lock and change this, or we have to adjust this on our own. So we're going to say 29.69. Let's move this down and we'll just do 29.60. We'll sell it at 29.60 or above, giving ourselves a little bit of room here to get into the trade. And again, remember, this is an illustrative and educational example. And we're going to click on confirm and send. We're going to read through this order. Get into the trade at a limit at 29.60 or above. Buy it back on that trigger below 29.22, or buy it back on that trigger above 30.82. We've got our exchange designated transaction costs in this particular case, and we see what our buying power impact is, which means that's what our initial margin is in this trade. And remember, that's related to that notional value of the contract. And we're going to go ahead and we're going to put this in our futures group, and we're going to fire that order off. We sold it, so we're in short, and we're looking at this moving to the downside. Getting out if it goes against us, getting out if it goes in our favor in this particular case. So what we're trading on here in this particular case, the premise is downward potential movement from this resistance level. This is a purely technical trade, but from also the perspective of saying when volatility is very high, it typically tends to mean revert and come back down. Doesn't always. Volatility can always go higher. Doesn't mean that just because VIX marked up here at that 55 mark, or these VIX futures marked up at that point, that it can't go higher, because it certainly can. News can change everything. But I wanted to get into that trade right off the bat just so that we can kind of see what's going on and take advantage of kind of that initial movement in the market. Now I'm going to change my grid here really quickly, and we're going to go back to our kind of overall look. Now we can take a breath. Now that we've got that trade on here in the morning and kind of getting that going, let's take a look at what's going on in the market as a whole here this morning. Let's start with the Russell 2000. This is the /RTY futures contract. And we can see that initially here this morning, we've got a bit of a bounce. And we saw some of that bounce coming in yesterday during the market. We saw this kind of, let's zoom in here on this right-hand side so that we can see this a little more clearly. Kind of this long-legged, we could call this not necessarily a long-legged doji, because a long-legged doji would be actually just a single kind of open and close at the same price, right? But this is a long, I'm going to call this, there's another name for it in Japanese candlestick parlance, but it's not a very nice name. So I'm going to not use that name. I'm going to use the kind of derivative name here, which is a long-legged spinning top, right? Long-legged spinning top. And that long-legged spinning top, meaning it's got a long shadow to the top and long shadow to the bottom, defines a large range, right, between high and low. But ultimately, there was coming to some equilibrium here. Now, that can be indicative. The fact that this came off of the top means that this could potentially be indicative of what's sometimes referred to as a dead cat bounce, meaning when you get a big push to the downside, and that's not a very nice term either, right? It just means that if you throw something down hard enough, meaning you get this downside momentum-driven movement hard enough that anything will bounce, including a dead cat, right? Which is gross. But think about it from this standpoint. There's a little bit of that snapback or sometimes that whipsaw effect that you're talking about, right? And we see this move to the upside. Now, it opened where it closed yesterday. The futures contract did. There was no gap in that movement, right? We're seeing that open at the close of where it was. Wow, that's, I think, a Harry Potter line, right? And now we see this move back to the upside, which is pretty strong today, but it's coming off of that top a little bit. So the question is this part of that kind of lift in that dead cat bounce? Because oftentimes that dead cat bounce will be maybe more than 1 day's worth of movement. So thinking about this, let's go back to kind of what we've learned. And if you haven't been to one of our technical analysis live workshops, or if you have not been through, say, for instance, our Getting Started with Technical Analysis series of webcasts, one of the things that some traders look for in terms of a reversal, in terms of getting into a trade that has been moving down and is now potentially moving back up, right? The question is, how do you know when that reversal, and I know this shirt is not available, at least not to the general public, I don't think. But I wanted to wear it today just because, you know. But that being said, how do we know when that reversal is happening? So some traders, it's a Thinkorswim shirt. Yeah, these are Thinkorswim logos. Some traders will use what's referred to as a close or a trade above high of low day. Cahold, right? Cahold. And that hold would come if the Russell, in this case, and this is likely to be the same that we'll see in the S&P 5 or the /ES and the /NQ, that would come on a cross or a trade above or a close above the high of yesterday, because that becomes our low day, right? So this is our low day right here. That's our low. Now we're looking for a cross above that level right there. So let's see where that level is in terms of getting bullish on this move in the short term. That would be a move somewhere above this 1933 mark on the Russell 2000 on the /RTY. That would be the Rubicon for this to cross, right? And so some traders are going to be looking for that. Now we're seeing RSI kicking back up and starting to turn back in an upward direction. So for some traders, especially some algorithmic traders, this type of move, right? A move below that reversal line and then back up above. And I'll just highlight that there on the chart. That move down below the RSI reversal line and then back up above can be potentially a bullish trade trigger. Doesn't have to be that. They may have their own programs and their own designations. For some technically driven traders, that represents an extreme that got touched, and then it's reversing from that extreme, and there's some buying pressure going on. So some traders are looking for that, and some traders are looking for this combination of those things, right? Clear evidence that there's a new high being made and a momentum or sentiment reversal coming from that RSI. And if you want to learn more about that and how to use the RSI in that fashion, there are some great webcasts that talk about that in our Trader Talks webcast page. By the way, that's a good opportunity for me to remind you to click on that subscribe button down there in the bottom right-hand corner. Subscribe to our Trader Talks webcast channel so that you have access not only to all of those webcasts, but any new archives that are dropped. It's at no cost to you. It helps you out. It helps us out. And by the way, you can follow me. You can follow Michael Fairborn and all of the other education coaches here at Charles Schwab on X at Ben Watson CS, at Mike Fairborn CS. That naming convention is the same for all of our other trading or other education coaches as well. So that's what we might be looking for here on the Russell 2000. Let's take a look at the S&P 500. This is the /ES. So going back to that conversation, right? In this particular case. And so Rita, I'm going to answer your question in this particular scenario, right? So here's what we've got. We've got first and foremost that little bit of a bounce or that little bit of a move from below to above that RSI lower reversal line, right? Okay. So now you start to see this reversal move. Now, James, I get it. And I know James Boyd has his own methodology for close above the high of the low day. So here's the thing. That's a low right there. And this is a low right here. And that's a lower low. This also indicates some momentum to the upside. So here's the thing. It's half a dozen of one or six of the other, right? Or 6 to 5 and pick 'em if you're a horse racing fan. That this high right here is a little bit later confirmation. This high right here coming off of that bounce maybe is a little bit earlier entry into the trade. So traders can use either one. And again, there's no hard and fast rules. And remember, technical analysis is all theoretical anyway, and none of this is a guarantee. All we're doing is looking for some kind of evidence. So here we are almost to that point right now, right, where we have that cross above the RSI lower reversal line from below and the potential. So let's set up this trade and let's kind of put this trade into perspective with Rita's question in mind. Now, I'm not going to do that here on the ES. In fact, what I'm going to do is I'm going to change our grid back to our futures movers grid, and I'm going to go to /MES, right? So we're going to go to the smaller contract, okay? Smaller contract in this particular case. Yeah, I like that, George. Split the baby. Let's play King Solomon here and split that range. So this is the smaller contract. Let's take a look at what that contract size is. $26,000 notional value as opposed to the big contract /ES, which is a $263,000 notional value. So let's go a bit smaller here, MES, and we're going to see that tick size 20.25, tick value $1.25, point value $5. So take that times the value here, and that gets you to the notional value of the contract. So let's come back over here and look at both sides of this. So here's what we're looking for on the longer term chart is that close above or that trade above. In this case, we'll call it 52.86. That's our line to beat. That's our mark to beat in this particular case, right? So what we're looking for then is a trade above that level. So we're going to make that a buy stop or a buy market on a conditional order, right? A conditional saying, fine, when it gets to that point, get into the trade, right? So here's then where we might look for a potential target in the trade. And going back to Rita's question, where would you put a stop if you were to place a trade after the close above the high of the low day? Would it be at the high of the low day or would it be somewhere around that? So think about this from that standpoint. Once that resistance, because that's what this is acting as, is resistance. Once that resistance is broken, what is it likely to become? It's likely to become new support. Doesn't have to be. That's theoretical. But old resistance can potentially become new support. So if we're using a if support is broken, then exit the trade type of perspective, then we could say, fine, that gives us our where we might put a stop order onto this trade. So let's kind of put this into practical terms. If we were to give it the risk of today's candle, right? So from this range down to this range, like at 51.16, let's say, fine. If it retraces all the way back there, that's going to be taking that trade off if it comes all the way down to that 51.12 level. And looking for, again, what we can do, and just in terms of a short-term trade, if we're looking for kind of a 2-to-1 perspective, and that's not an absolute by any means, right? Easy way to do this is to simply take that range right there, duplicate the line, right? Put it up there. I mean, if you don't want to do the math, just duplicate the line and then duplicate the line again, right? And put that line back up here at the top of that previous line. I mean, we're ballparking this anyway. I mean, this is not in any way, shape, or form. This is kind of my Jimmy Buffett approach to technical analysis, which is not too particular and not too precise. I'm not trying to calculate that to the penny, but that would give us about that 2-to-1 perspective on this trade. And it would make logical sense in the context of levels of support and resistance. So our target in this particular case is going to be right up here around 5,666. Our stop in this particular case, right around 51.07, getting in this trade. And our trigger to get into the trade would be crossing this line right here at the 52.87 mark. So that's where we're going to put this, perhaps a bit longer term trade into perspective here in the ES, which is moving a little bit faster than what we're seeing here. Now, could this fail? Yeah, absolutely. Could it fail to enter? Yeah, absolutely. But let's put this trade together. We're going to come right over here to the chart. I'm going to right click. And we're going to do a buy custom because we're going to go long the futures contract here with that OCO bracket. Now, our entry in this particular case, we could make this a buy stop. Now, remember, if we make this a buy stop, that's fine. We have to just remember that that's also going to be worked as an exchange-driven limit order, not a market order. So there is the potential for this order to not fill at all. So we're going to use 52.86 as our limit. So we're going to say buy stop only if this gets to 52.86. We'll call it a little bit higher than that. We'll call it 52.87 just for easy math. 52.87, and we're going to make that a buy stop. It's a stop wait. Don't get into the trade until it breaks that level. That's the reason for the buy stop. Not that we couldn't get into it now, and we'd get into the lower price, but there's no guarantee and there's no indication or confirmation of this moving higher at that point, right? So buy stop. So we might not get filled today. I'm not going to make that a good till canceled on that entry order. Now let's take the other side of the trade, which is if it goes in our favor. We said 56.66 to the upside. So we'll just write that in on our first limit order, which says sell it if it gets to that price, 56.66.00. Enter. And that one we are going to make a good till canceled. That's going to be a limit order. So that limit order is automatically going to work as a limit order and isn't subject to that substitution on the part of the exchange, because that's already a limit order. Now, the other side of the equation is down here. If this goes against us, we said 50.90. We said 50.96, right? 50.96 in this trade. So we'll just put this in 50.96, and we're going to make that a stop. So stop, wait. Now, we could make this a limit order on our own. We're going to make this good till canceled, recognizing that that is going to be substituted by the exchange for an exchange designated limit order, and there's the potential that that order could not get filled. Likewise, the reason for that is given that this is a market order, and if the market were moving to the downside quickly, which this market can, then there's the potential that that order could fill at a substantially lower price, especially in a futures contract, as those markets can move quickly, especially with volatility, that order could get filled at a substantially lower price. So the exchange is going to, for protection purposes, work this as an exchange designated limit order. And that's what we've got here in this particular trade. We're going to go confirm and send. We're going to put this in our futures group, and we're going to send that order off. And we'll wait to see if that order, in this case, triggers for us. All right. Okay. Now, let's go back. Oh, I was going to share the futures movers grid with you really quickly here. So I'm going to click on share grid. This is already in the description for the webcast, but I will share it with you as well. And remember that anything that we share is for illustrative and educational purposes only, number one. And number two, it is not guaranteed as to time or accuracy. All right, so that's what we've got there so far. Let's come back over here to our futures grid. We've looked at the Russell, we've looked at the S&P 500. Let's see what the NASDAQ is doing here in the short term. And the NASDAQ doing much like those two are doing here. So a little bit of lag in the small caps at this particular point. Technology lagging just a little bit behind the broad market, but the broad market seeing a strong bullish reversal here, not yet giving us that close above the high or that trade above the high of the low day yet. So starting to see that potential movement. Now our ES trade got filled, and we are now long that contract. Okay. Now here's what I want to do with that. Now that we've got that contract in place, what I want to look at is I want to go to our portfolio, and in our monitor tab on our activity and positions, I've got a portfolio of stocks, stock positions in this particular group. And this is just kind of a typical, these are not recommendations, this is just a sampling. And what I've done here is I've included a column in my monitor tab talking about delta. Delta is that relationship of dollar movement relative to price movement of the underlying position. So each one of these individual stocks has its own delta. It has a delta of 1. So if AbbVie goes up $1, it gains $1. If it goes down $1, it loses $1. If Delta goes up $1, gains $1. Goes down $1, it loses $1. So overall, collectively, I'm long 1,100 deltas, but they're all different deltas. They all move at different rates. So if I can kind of collect these and put them into a common denominator, we've talked about this before, I'm going to use beta, which is a coefficient of movement. Beta is a representation of how something moves relative to something else. So I'm going to create a common delta by using beta weighting, and I'm beta weighting to /MES, which is the S&P 500 micro contract that we just entered the trade in. So what this tells me is that this stock portfolio is sensitive to the tune of about 14 deltas to that movement of the S&P 500. This is kind of a broad cross section. I don't have any technology in here. I have a couple of communication services stocks in here, but it's kind of broadly utilities and staples and some discretionary here and as well. So it's got some sensitivity. So here's the thought. We talked last week about hedging against downside potential and offsetting or reducing that number of deltas to reduce the sensitivity to downside or adverse movement. One thing that traders might also think about doing in the case of strong short-term moves is augmenting the sensitivity of the portfolio to moves in the direction that they want that trade to go. So we just put in a long trade on /MES, which benefits if the S&P 500 goes up, right? And the /ES futures contract goes up. So what if we add that performance, that upside performance to our stock portfolio, which is sensitive to the tune of about 14 deltas to the upside. So we put that contract in here. That's our /MES contract. And what if we did this? Right click and move that to the group stocks. And now that futures contract is in our stocks group. There it is right there. Notice that added, in this case, 5 MES deltas into this portfolio. So now our overall portfolio has been augmented or boosted by that futures contract addition in terms of its overall sensitivity. Now, the downside to this, and I always want to balance that exuberance here with the risk, because if this turns to the downside, if the S&P 500 starts to move down, that means that sensitivity is larger to the downside. Futures contracts giveth and futures contracts taketh away, for sure, right? So from that perspective, you got to make sure attention must be paid. In this case, as Stephen Sondheim says in his musical Assassins, that we don't over leverage or over sensitize our portfolio in one direction or the other. It's fine, but especially when volatility is high, make sure that a trader, as you look at this, is aware of that. Now, what could be done in this particular case? Close the futures contract. Close that futures order if it starts to go against you, or go short the futures contract and reverse the position and reduce some of that sensitivity. That's how a trader may use futures positions to augment or offset movement within a portfolio. All right, we've got a couple of minutes left. So here's our volatility futures contract, and it's kind of working against us. It hasn't stopped us out yet, but futures still moving to the downside a little bit. One other that I wanted to look at here that was moving a little bit this morning, and that is, let's go over to our charts again. I'm going to go to our futures movers grid, and I want to look at /6M. This is the Mexican peso futures contract. So this morning, this was starting to move to the downside, but what I happen to notice is that this is moving in the opposite direction here, starting to see that move to the upside. You see that I had already started to line out this trade a little bit to the downside, and in fact, it's going against us. So one of the things that it's important to do is make sure that a trader checks their actual performance of a position or of a potential trade against what's actually going on, right? Because when I started putting this trade together this morning, this is where we were. We were right about here, okay? And this is what I was seeing, was that, well, okay, this is coming up a little bit. It looks like maybe about, actually, I think I was probably right here when I put this trade together. I'm looking for that potentially bounce into that resistance level and move down. Well, now as time progressed, it broke back up through that range and tested above that resistance, now starting to move to the downside, now starting to rally a little bit here. And as we look at these 5-minute candles, now starting to move to the upside. So my initial premise was downward directional movement to take that trade. Now looking at this as maybe a potential move to the upside. Now, given that we've talked about that, I also want to look at one of the questions that came up here in the discussion, and it's something that we did last week just briefly, but I want to go to my single grid chart here really quick, and I want to look at /VX, the volatility futures. Remember, we traded in that example trade /MV or VXM, the mini contract here. But what I want to look at is the future curve of these futures contracts. And we've talked about contango and backwardation in this class before. But what I'm going to do is I'm going to go to my product depth selection here on my charts tab. And I'm going to put in here /VX. And we're going to look at that futures curve, not for /ZM. I don't want soybean. We talked about that before. But VX. This is VIX, volatility. Here's the futures curve for volatility. Normally, the futures curve for volatility looks like this. Spot is lower than out in the future because there's more risk in the future. Now we're in a situation where here's spot VIX, and here's what each one of those futures contract dates is currently priced at, which means that there is a downside expectation for volatility. That's normally the case for volatility, is that when it gets to an outsized move, it backwardates like this, and we get that backwardated relationship because it's a mean reverting instrument. When this curve reverses and goes back to this contangoed curve, then that's kind of that normal scenario. And there's kind of that upward expectation overall in volatility. But when volatility gets high, it goes low. When it gets low, it comes high. It's mean reverting. So that's kind of the perspective on volatility here. So here's what I want to do before we get out of the discussion here today. I know we've got just a moment or two left, but I wanted to give you some resources because somebody had asked me the question last week, so I wanted to pay off on that. Is where do you go to learn how to trade futures, right? To learn the basics. So what I'm going to take you to is schwab.com. So I'm going to take you back here really quick. We're at schwab.com/coaching, and this is where you're going to find live webcasts. This is where you're going to find in-person events. But then I went right up here to the Learn tab, and over on the left-hand side, I went to Futures. And in that Futures group in the Learn tab, now you're going to see things like how to trade futures on Thinkorswim for beginners, trading futures, this webcast from January, and how to trade futures from beginners. That's Cameron May. S&P 500 futures, some of the basic fundamentals. Micro E-mini futures, 7 tips each futures trader should know. Trading futures, another webcast. Overnight trading in futures markets. Tick values, margin, all kinds of great stuff there. And then come over here to the Trader Talks webcast channel and type in here futures, and you're going to get all of the webcasts that talk about futures over here on the right-hand side. Guys, thank you so much for being here. My thanks to Michael Fairborn for helping out, and thank you to our great production staff. Guys, follow us on X at Ben Watson CS, at Mike Fairborn CS. Remember to click on subscribe when you're right here. And that's going to help us out, and it's going to help you out. Also, thanks to our great staff behind the scenes, everybody that helps out, Mindy and Nikki and everybody else that helps out with these webcasts. We appreciate it. And we will see you guys again next Tuesday. Have a great week, everybody. We'll see you soon. Bye-bye.